If you just clicked on this video, then it means you're Canadian who either invests or you want to start investing. And good news, because you're in the right place. In this video, we're going to be breaking down everything there is to know about the TFSA, which is an investment account that the Canadian government introduced back in 2009 as a way to incentivize people to save and invest for their futures. So by the end of this video, you're going to know everything you want to know about the TFSA, how it works, and why you should be using it to invest. So typically when you invest in a regular investment account, you're obviously putting your money in there and investing it so that it grows over time. But then eventually down the line, when you do go in and want to use some of that money, you have to sell off your investments and you end up having to pay taxes on what you sell. Now, the government of Canada has introduced a few different types of tax advantage investment accounts to incentivize people to want to invest more and not worry about the tax burden so much. And there's a few different ones and they all have different tax benefits to them. So obviously the one, like I already said, that we're talking about today is the TFSA, or tax-free savings account. Now, the name itself is already a little bit off. We're gonna fix it up for you on the screen right here, and that's better. It's really more of a tax-free investment account than a tax-free savings account. Yes, you can just put money in there and let it sit and use it as a savings account if you wanted to, but it's really not using it to all of its full perks and benefits. We're gonna cover all of those different benefits, but the main one that you should know about right away is the tax-free part. And it's the fact that the investments that you have within this account, they're protected from paying any taxes on them should those investments grow and end up making you money. Now, this is the real reason that you should be using the TFSA to invest more so than saving. And to break that down a little bit more, let's say you were just going to put money as savings into this account. First of all, you're not even going to be gaining any interest on this unless the platform that you're using had some sort of promotion when you signed up and opened it. But in general, typically you're not even earning any interest on the savings sitting in the TFSA. And then the second piece is it also takes up room that you could use to invest and make money. So for example, let's say you have $10,000 in savings, so just in cash, that you put into a TFSA. Sure, later on you'd be able to withdraw that TFSA tax-free, but wouldn't it be better to instead put $10,000 in there, invest that money, make a profit, have your money grow to, let's say, $20,000, and invest that higher amount tax-free instead? It definitely would. So this is why we keep our savings, our emergency fund specifically, in a high interest savings account. It makes some money. Yes, you do pay taxes on that income that's earned from those interest rates, but at the same time, you still have more room to invest within your TFSA.
Okay, so why is having a tax-free account so important and just useful in general? Well, it's because it's the best way to maximize your investments and how much you're actually earning from them. So obviously we can do this in a couple different ways, a couple different investments, but the first one is interest earned. That's the first category. So you can either, earn interest from saving your money, putting your money into GICs, bonds. That's another great example. And the second one is dividends, right? So you can earn this either through investing in certain stocks or certain ETFs. So when a company has a lot of money, they've done a really good job, good profit, right? They'll sometimes give that money back to their investors. So that's what we call dividends. And then the third one is capital gains. And this one is a really big one. So capital gains is going to be when you make a profit by selling your certain investment at a higher price than what you initially bought it for. Now, if you buy all of those investments inside of a TFSA, all of those gains and all those profits that you're going to be earning are going to be tax-free, right? Tax-free. So before we even get into the intricacies of the TFSA, first and foremost, let's understand what I mean by buying within the TFSA, right? So the first thing that you really have to understand about the TFSA is that the TFSA itself is an investment account. It's not an investment, right? Picture it like this. So the example that I really love to use is the laundry basket example. So picture the TFSA as a laundry basket and picture the investments that you're gonna be buying as what goes into that laundry basket, AKA your clothes. So at the beginning of the week, right, you just did laundry, right? Your laundry basket is usually empty. As the week's progressing and as you're wearing more and more clothes, what's gonna happen? You're gonna start putting those clothes into your laundry basket, right? So the way that I like to picture it is that your TFSA is your laundry basket and your clothes are the different investments. So as the week progresses or as your knowledge progresses, right? And now you wanna start buying different investments. As that happens, you start adding those investments into your laundry basket, right? Into your TFSA. Overall, the TFSA is what holds your investments. That's what you need to understand and take away from this example. TFSA holds the investments. Now, the investments that you can buy within your TFSA include individual stocks, bonds, different funds. So let's say, mutual funds, ETFs, index funds, you name it. You can hold different REITs, so real estate investment trusts, and you can also hold cash. And I think the next question that you would probably have after learning what you've learned so far is, how do you actually open an account up? How do you actually use it? So the first question you got to ask yourself is, which platform do I want to use? So by platform, there's kind of two different routes. There's the traditional route by going to your bank, and there's the not so traditional route by using an online brokerage. So ideally, we'll do both. So traditional route, you go to your bank or you go online and you just open up an account. That's the platform you've chosen. The other way around is you ideally choose a low fee brokerage, online brokerage, where you go on the platform and you open an account yourself on that platform. So either way, you still have to go in and actually specify, I would like to open a TFSA account. And then once you do that, you're kind of on your way, right? All you got to do now is figure out which investments you want to buy, and you buy them within that specific account. And now that we've kind of covered the basics, I know it sounds pretty simple, and it can be, but there's also some rules that you really need to know.
One of those rules is that TFSAs have contribution limits. So what this means is that there's a maximum amount of money that you can actually contribute into your account before it says, nope, no more clothes can fit into the basket. Now, the reason that this exists is because otherwise we'd just only want to use this account to invest. Why would we want to pay taxes if we don't have to? But obviously the government still wants us to pay taxes on some of our investment income earned, so there's a cap there. Now, as long as you're 18, you're a resident of Canada, and you have a valid SIN number, that's when you can start to use your TFSA. And as soon as you have your 18th birthday, that's when your contribution room actually builds up too. Now, basically the Canadian government decides on a certain amount of money to add to your contribution room each year. So some years it's been $5,000, then it was $5,500 for a few years, one year it was $10,000, and then most recently it's been $6,000 per year. And they always announce what the next year's room will be at the beginning of the year. Now, something to note is that your room is actually cumulative. So if you don't use that $6,000 of contribution room this year, it's not gone forever. It adds onto your total amount of room and it builds from age 18 onwards. So let's break down some examples of what I mean by cumulative contribution room. So since the TFSA started in 2009, it means that if you turned 18 in 2009 or earlier, so if you were born in 1991 or earlier, it means that you have the maximum amount of contribution room that anyone can have at $81,500. Now, in my case, I was actually born in 1996, so later than 1991. My contribution room in total, if you add up all of the different amounts that they've let you add for years since my 18th birthday, I would have a contribution room of $56,000. Now, Dennis's case, he was born a year before me in 1995. It means that he has more room than me at $61,500. Now, let's walk through an example here. Let's say that I've never used a TFSA before, never in my life have actually put any money in it. It means that I still have the full contribution room of $56,000. On the other hand, let's say that I've maxed it out. I'm currently at 25 right now. My room is $56,000 and I've added $56,000 to my account. I can't add any more. Next year, if the contribution room increases $6,000 again, it means that as of January 2023, I could add $6,000 more in, and then I'm maxed out again for that year. So basically, when you start adding money into your TFSA, you're working towards maxing it out, and then year after year, you can only add in the new contribution room. But if you've never invested before, that new additional contribution room, that's not really relevant to you until you get to that point that you've maxed out your cumulative room. So let's get back into talking about some of the benefits of using the TFSA. Obviously, we were just focused on what it looks like when you're putting money into the account originally, but one of the main benefits comes when you're actually taking money out of the account. And that's the fact that you can withdraw your money from your TFSA at any time without paying any fees or taxes on it. That's the big one. So let's actually take an example and compare the TFSA to a regular investment account, a non-taxed advantaged one. In this example, let's say that I was investing within a TFSA and Dennis was investing within just a normal taxable account with no advantages. Let's say theoretically that we both invested the exact same amount of money for the exact same amount of time, and then we ended up making the exact same amount of money on our investments. When it came time for us to take our money out, I would be able to withdraw that full amount of money and keep all of it without paying any taxes, whereas he would have to withdraw it, pay taxes, and he'd have a lot less money than I would.
Okay, so with that being said, now let's actually go over a question that we get a lot. And I think people just naturally, as they're learning more, come across this question. So people are constantly asking us, if I withdraw from my TFSA, do I lose that contribution room forever? So short answer is no, but there is a but. And we'll get to that but in a second here. So I think the best way to visualize this is gonna be through an example. So picture it like this. If at the beginning of 2021, right, you contribute $50,000, you invest $50,000. If that money, by the time August of 2021 rolls around, grows to $55,000 and you decide to take that money out, right, you're not allowed to recontribute that $55,000 in that same calendar year, right? However, you can recontribute either the next year or the preceding years after that into the future, along with any additional contribution room that's added by the government. So what does that mean? That means $55,000 you can recontribute next year, plus whatever the added room is. So whether that's $5,000 or $6,000. Now on the flip side, let's talk about that but, right? So if you were to put into your TFSA $50,000 and somehow, things went horribly wrong, you didn't invest it into a good investment, and your $50,000 now fell all the way to $10,000, so you lost money. If you decide to withdraw the $10,000, you're not allowed to recontribute $50,000, right? You have now lost contribution room. That's how it works. If you sell your investment at a loss, right, you can't contribute what your investment used to be. You can only recontribute $10,000 plus whatever the additional contribution room that the government gives you on a year-to-year basis, right? So next year, I can then recontribute $10,000, not 50, plus $5,000 or $6,000 or whatever the government says. The important thing to take away here is that you have to be the one who's keeping track of everything, right? Technically, your account will let you put in any amount of money that's possible, right? And keep in mind, if you over contribute, you're kind of screwed because you're going to be charged 1% for the total amount that you're above and over that contribution limit every single month until you take that money out. So once again, you have to be the one who's staying on top of it. Another thing to note about the TFSA is that you're allowed to have multiple accounts. So once again, not really necessary, but if you wanted to have one that just holds your stocks versus your index funds, you could do that. If you had one open with your main bank and another one open with like an online brokerage, you could do that too. Really, the main thing that you have to remember is that, all of these accounts, whether it's 5, 3, or however many, the total amount of all of these accounts needs to add up to your max contribution limit. So to give you an example, let's say your max contribution limit is $50,000. That means if you have two TFSA accounts open, you can only have, let's say, $40,000 and $10,000 in another one. You couldn't have, let's say, $40,000 and $20,000 in another one. Also, one of the most important things that you have to remember is that the income earned inside of your TFSA, that doesn't impact your contribution room. The contribution room, once again, is the amount of money that you actually put in. It's not any additional money that you've made on top of that. Remember that.
Now, something that's super important for you to know about is the protection that your money has when it's in these different investment accounts like the TFSA. Now, we're actually working with CDIC on this video, which is really exciting. And if you haven't heard of CDIC before, it stands for the Canada Deposit Insurance Corporation. They're a federal crown corporation that was created by Parliament in 1967 in Canada, and their main purpose is to insure bank deposits up to $100,000 in each different eligible category in any of their member institutions like Canadian banks and also federally regulated credit unions. What's great about it too is that you automatically have their protection as long as you bank with one of those member institutions. We'll have a list somewhere up here or in the description box for you too. Now, if any of those banks or federally regulated credit unions were to fail, then you have their protection and you don't have to sign up on your own. Now, something important to know about is what they actually cover. So in general, what they cover is checking accounts, savings accounts, GICs and other term deposits, and also foreign currency. But what they don't cover is mutual funds, stocks, bonds, cryptocurrencies, and ETFs. Now, they also cover up to $100,000 in 7 different categories, and one of those categories is the TFSA, which is obviously the relevant one to this video. So let's take a look at an example of that laundry basket, going back to that example of your TFSA. Like I just kind of went over, it would cover some of the different pieces of clothing, the different articles that you could have in your laundry basket, but not all of them. So let's say that you have a TFSA and you have a few different investments in there. Like maybe you have $25,000 in ETFs, $10,000 in individual stocks, $10,000 in GICs, and $5,000 in cash. What that means is that $20,000 of your $50,000 invested would be covered by CDIC and protected. And that's specifically the ones that are in their eligible categories like the GICs and cash.
All right, guys, that's it for the TFSA. And as usual, if you have any comments, questions, let us know down in the comment box below. And yeah, huge shout out to CDIC for working with us on this video. We're actually doing a 5-part series where we're going to be covering a bunch of other different accounts. So for example, the RRSP, RESP, RDSP, and trust accounts. Yeah, so we've got a bunch of like really great videos kind of coming up in the next couple of weeks. So keep an eye out for that. And yeah, if you want to check out CDIC's website and learn more about them and some of their resources, make sure you check it out down below. And yeah, if you haven't already liked our video, make sure you like down below and subscribe right there in the corner. And if you haven't seen any of our previous videos, make sure you check them out next. We will be back. You know the vibes, and let's go.